Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, April 9th. The global trade war escalates as US tariffs went live this morning. The markets are shattered. The US dollar and oil are down, gold is up, and global central banks are showing their support to their economies. The Fed, however, not just yet. Meanwhile, discussions among the US Republicans and once Trump supporters are getting very, very heated. So hopes of seeing Donald Trump roll back his tariffs before they go live have just got dashed this morning, as did sentiment across the global financial markets. Nikkei index in Japan is down by more than 2% at the time I'm talking here. A Bloomberg index that tracks Asian currencies fell to a record low level as European and US futures hint at another very, very ugly trading session with losses across the futures nearing 3 to 4% at the time I'm talking here this morning. And I won't comment much about yesterday's market rebound, as I repeat and repeat and repeat again. The rebounds of this magnitude, above 2 to 3% in just one session, are not sustainable unless there is a clear resolution to the tariff problem, which is not the case for now. Now, there is one brightish spot in the market though this morning, and it's China. Despite being hit by 104% tariffs from today from the US, the Chinese authorities have said that they will fight to the end and they will not surrender. And the latter probably includes massive and maybe unprecedented measures to keep the Chinese economy afloat. And one of them is obviously to let the yuan weaken to absorb at least a part of the tariff cost, the tariff shock, and the dollar yuan has actually weakened to the lowest level since 2007 this morning. And we know that there will probably be interest rate cuts, cuts in reserve ratios, liquidity injections, among other measures from China that the Chinese will bring one after the other on the table to hold their ground and to keep investors, well, kind of happy as much as they could. And China is not alone to promise supportive measures, mind you. The Reserve Bank of India and the Reserve Bank of New Zealand also cut their interest rates by 25 basis points each today. Kenya dashed its own rates by 75 basis points, pointing at tariff policy uncertainty. And the European Central Bank is also expected to do the same, so a cut by 25 basis points when it meets next week as well. And JP Morgan analysts actually expect the ECB to cut its interest rates at each of the next 4 monetary policy meetings to give support to the underlying European economies that will take the hit of tariffs, which will be 20% from today. In the FX, we see Trump policies continue to weigh on the US dollar on the rising recession bets. Probably the dumbest recession in the world history. And the problem here is that the US Federal Reserve hasn't yet given a public support to investors about all this. The Fed members rather keep saying that the US monetary policy is right now in a good place to cope with the tariff disruption. Now, I believe that a further risk sell-off across US markets could eventually bring the Fed to change its mind, but the Fed officials are, like everyone else, worried about the potential impact that the massive tariffs will have on the US economy and inflation before deciding what to do next. Because for now, we don't know who exactly will pay these tariffs when foreign products come to the US border. Will exporters of goods toward the US be willing to pay for the majority of these tariffs to protect their market share in the US? I mean, that would be the dream, the best ideal scenario for Donald Trump, obviously, and make him grandly success in this trade policy, as not only the US consumers wouldn't be hit by the tariffs, but he would also put all that money in the US government's coffers and spend it to become more powerful and make America great again. Or the second option is, well, the exporters will pass the additional costs onto the US consumers, thinking that the tariff situation could not last long anyhow, and it's just better to go out and look for new markets sooner rather than later. And in this case, well, the US inflation would take a lift, and that would eventually leave the Fed a bit annoyed with rising inflation, but not powerless still, because the Fed could still help the US economy and the US financial markets to weather the shock, but inflation would inevitably hit people and eventually hit Donald Trump in the midterm elections of next year. Now, many think that China will take that bet, the bet of losing market share in the US due to higher prices, but hoping that inflation will hit the Americans so hard by the end of next year that they will change their mind on Donald Trump. And I'm not a political expert, but if the negotiations with the US and the rest of the world don't lead to a reasonable outcome for the rest of the world, the Europeans, for example, an interesting thing to do would actually be to make peace with China again, so that everyone can take a softer hit from the escalating trade tensions of the moment. That's obviously an absurd turn of things when the global geopolitical tensions have risen to the highest levels in decades, and China is not necessarily an appetizing place in terms of geopolitics, but it's up to the politicians to be smart enough in these agitated waters. In the FX markets, the dollar's weakness pushed the euro dollar again over the 110 psychological mark this morning. I think that levels below the 110 level are interesting dip buying opportunities for the euro bulls, because if the global trade war intensifies, and it looks like it will, the euro could amass a part of the safe haven flows. In fact, and despite the European and German plans to step up the government spending to fill in the gap that the US leaves behind in terms of security, the German bonds are increasingly seen as an interesting alternative to the US government bonds that are considered to be safe haven. Remember, because the German 10-year bond yield is consistently coming down since the mid-March peak, while the US 10-year yield actually spiked from below 4% to above 4.5% level in just 3 sessions, and the US 30-year yield just hit the 5% level a few hours ago, as companies out there are selling their liquid assets to get cash to weather the shock, but not many are willing to buy these bonds. And there are also rumors that suggest that the Chinese may be dumping their US Treasury holdings as retaliation to the US tariffs. So all in all, the mounting financial stress in the US government bond space will probably require a Fed intervention in the coming hours and days if it doesn't calm down by itself. So I'm not necessarily concerned in the short run about the Fed's capacity to calm down the financial markets nerves. But in the medium to long run, a potential US isolation could eventually rebalance the world's safe haven balance, and Europe could actually benefit from that new world order. Now, one hope is again to see the US resolve this tariff problem from the inside. Elon Musk called Peter Navarro truly a moron and dumber than a sack of bricks, while Republican Senator Mr. Tillis asked everyone, whose throat do I get to choke if this turns out to be wrong? And meanwhile, the US and politicians and the big businessmen there are looking for someone to blame. A potential replacement of US Treasuries by gold by the Chinese and other central banks could actually well explain a part of gold's recent rally above that $3,000 psychological mark, and gold is well bid this morning in the middle of the fire and dust. US crude, on the other hand, traded below the $57 per barrel level this morning as the escalating trade war across the world hammers the global growth prospects and the global demand prospects. As such, the outlook for oil remains negative, and the next natural target for the bears stands near the $50 per barrel psychological level. And note that I have just started hearing new targets for the bears as low as $40 per barrel level. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.